Hey everyone, you're listening to the Active Turnkey podcast, a podcast designed for hands-off, passive real estate rental investors. In the Active Turnkey podcast, you'll hear Tom Olson and Jarrod Stotmeister discuss all things turnkey rentals with other turnkey providers, service providers, and rental investors. Our goal is to help you reach your financial freedom and whatever comes after that. Let's go. All right, welcome back to the Active Turnkey podcast. I'm Jarrod Stotmeister. This podcast is presented by Olson Group. And today we have a special guest and from a special location. And we have the legend, Aaron Chapman, here with us. Is that right?
I don't know how legendary I might be, but I'm sure I have, there's going to be a few legends total around the campfires, but sure as I can't be I'm sure they would be something that's not flattering for Aaron Chapman.
But sure. Well, tell me, where are you at right now? Where are you filming?
I am at my place in Missouri. So this is an office. This is actually my office here in Missouri, and it's in the Ozark Mountains of southern Missouri, in just outside of Branson. And a situation happened years ago where I was forced to have to get brick and mortar here. It's a state where you have to have an office and you have to have a licensed person within the state. And it's a rather lengthy story. It might be one that I share either on another podcast, or I'll just put it on my website. I'll do the story there and I kind of show people there, because it can get lengthy on the situation. But it was a scenario that was really, really a tough scenario for me. It's almost like a hardcore slug in the gut. I had to come out here and take care of the problem myself. I ended up with this. So pretty darn awesome. So I'm out here with my pop. I'm going to turn the cameras a little bit. I'll let Pop wave to everybody. So you can see that there is that I actually came from somewhere. I didn't just crawl out of a cave.
Right. Well, that's good. It's good for our viewers to know that. That's important.
Exactly. That way we can identify in some portion, right?
It's all coming together. So I'm
out here. I spend 1 week a month out here because it's probably, to me, the best place in the world I can work. Because when I sit down here and I start getting involved in whatever I'm working on, I can spend 16 hours here at this desk and not notice it. It's just one of those real serene environments. I can really think. I can really dig deep in what I need to do. The only tough part is I got a cabin next door right here that's being rehabbed and it's taking way too long. And so I get really involved in what's happening there too.
Well, that goes into a whole other issue. Then that's a different podcast, I think, is the rehab, that rehab. But
oh yeah.
But now today,
that's where you really need a professional with the rehab budget and all that.
Wow.
Somebody who understands what they're doing. I'm not saying these guys don't understand, but I gave them a one-off project, and boy, did it get tough. And we went through a few people till I found somebody who's really, really a solid professional.
Well, that's good. And sometimes that's how it works. We've had that situation where, you kind of get in a project and that contractor, maybe he's done one from you before or not, I don't know, but they show their true colors and you're kind of in a mess. So it's nice that you got somebody over there who's getting the job done for you. So tell me a little bit about Aaron.
Right on.
What's Aaron do?
I've been in the real estate finance arena since 1997. I crawled out of the mines in New Mexico. My pop and I were working together in northern New Mexico, on the Colorado New Mexico border in Cuesta, and we were mining for molybdenum. I don't know if you know what that mineral is, but have you ever heard of chromoly steel?
No.
Well, how about, I get into moly grease. I can get all kinds of stuff. You ever see the word moly on anything? That is molybdenum, and what they do is it's an additive. It's a mineral additive for many things. And so that's what we were doing, and they started shutting down the project. It was with Unical, and I was one of the newer guys to have been hired on at that time. So I was one of the ones early to be let go. And so I went back to Arizona, and I stumbled my way into this, and that's a whole other story, right? It started out thinking I get a job real easy. Did not work out that way because I had a background cattle ranching with my father. Worked in the oil fields of Wyoming, worked in the mines. I ran heavy equipment. I drove truck. I had a pretty good resume at that young age, and I kept getting turned down everywhere I went. And I found the last place I went to try and get a $10 an hour truck driving job, hauling landscape material. I didn't get that job. They turned me down, said that I was too overqualified. I remember sitting in the parking lot in my truck, literally shedding tears. I started up my truck. I headed down the road to pick up to go to the grocery store and pick up diapers for my infant son. And I had a coupon for those diapers because we couldn't afford them. And on my way there, the gas light pops on my truck. So I pulled up to a grocery store that had a gas pumps out front. I swiped my debit card and it got declined. So I was overdrafted on my account. And I was forced to park my truck and start walking that parking lot for about 2 hours looking for change.
Wow.
And that was back when gas was like 80 some cents a gallon.
Sure.
So I was able to get enough change to get 2 gallons of gas to make it home. And then I went into the grocery store, found the corresponding diapers with that coupon. I bought them. As I walked out, I ran in face to face with a guy who I used to do business with. He used to do all the schedule work at an equipment company I dug swimming pools for a few years before. He asked me what was going on, I explained it, and he took me and my wife to dinner the next night with a gift certificate. This is before gift cards, that he got from a client that he did a loan for at Red Lobster. It was back when Red Lobster was awesome. And so we went to Red Lobster there, and he shared with me the mortgage industry, gave me a card for a mortgage broker that he knew, and I started as a telemarketer the next week, and it was a big slice of hell. But I needed to break the mold. I needed to be something different because I was not having any other opportunity. And it took me from 1997, I really worked my guts out, to now. Today, I sit ranked in the top 1% of my industry, and I am ranked. Last year, I was ranked number 12 in the United States of all 300,000 licensed loan originator. I'm ranked number 12 for units closed. And that was 2017. 2018, I was ranked number 14. Even though my production went up, there's still other people who their production went up, right? So the people who are really, really good got better.
Right.
So ours went up, I think it was 7% from the year before, even though the market saw a 40% decline in loans closed. We went up that percentage. Other people went up as well. So it just shows the people that are really, really good keep getting better. And we also noticed that the average the lender in our industry, or loan originator, which is what I am, went down almost by half.
Wow.
I think it's 40% in volume from year over year, or we went up. So very, very proud of the team I've got, or very, very pleased with the team I get. Let me put it that way. And pleased with the people I interact with, yourselves and others who have trusted us with their business. Because we feel like the real estate investor who comes in as buying investment real estate, they're like the CEO of their own real estate investment firm, right? And they take on the Olson Group as the regional operations division. Literally, you guys are their entire operations division for that region, and to get you guys for free all your experience, all the failure we just talked about, the mistakes that are made with contractors, all the good judgment that comes from the bad judgment that was exercised, they get that for free from you guys. I'm offering the same. I want to be the CFO for their organization, and I've got 21 years of experience to show for it. I closed 707 transactions last year for real estate investors. That's a lot of judgment at work that I get to put to play for them. I know you asked me what do I do, and I gave you a long-ass explanation, but that's how I roll.
Well, you nailed it, as usual, right? Well, I was going to ask you what's the latest in lending? Is there anything going on? And there's a lot of trends going on. Anything you're seeing? You just kind of went over that a little bit about what you're seeing in the community there with all the deals being closed. Are you seeing it trending going up in 2019? What are you seeing?
Interesting thing. A lot of analysts are saying that with the way the market's going, we just hit the inversion of the yield curve. So you're probably fully aware of that. There's probably a lot of people on this podcast that heard that discussed. So I won't go into the depth of the yield curve inversion, looking at the treasuries, but that always is the precursor to some sort of reset, right? We've seen recessions hit directly after that every single time. So analysts are saying within a year to year and a half, a pretty heavy recession. In fact, there's some saying that it may even be worse than what we saw in 2008 on up. So if that's the case, we got to be prepared for that. Right. But the one thing I've noticed, if you start looking backwards, I don't have the charts in front of me, otherwise I would have shared it with you, that even though the cost of housing went way down after the crash, rents went up. There's only one period of time that rents did not incline, and that was between 2012 and 2013. It literally flatlined. It didn't really decline. It kind of flatlined, maybe a slight decline, but they continued to rise. So I also just noticed that trend-wise, more and more people are understanding that investment real estate is where they should be investing their money. Another trend that we're seeing is there is an increased request, and it continues to happen out of Washington, that they keep looking for how are we going to impact lower income housing? How are we going to do that? How are we going to allocate enough funds to be able to contribute to people with lower income to be able to buy a home? There's still this push for the American dream. Me personally, I always thought the American dream was complete crap. When you start thinking about, you got to own your home, you've got to, that all your wealth is caught up in your home.
Mm-hmm.
That's one of your biggest expenses,
Yeah,
right?
absolutely.
And especially when you're talking about the lower income housing world. Let's talk about Gary, Indiana, where you guys stomp around in.
Mm-hmm.
How many people that can barely afford to buy that home and then need assistance from the government to buy that home have the disposable income to fix it up?
Right.
Think about that. How much money do you guys put on the average into a home out there in Gary?
In Gary, we're probably putting in 20-ish, I would say.
20 grand.
Mm-hmm.
$20,000, right?
Mm-hmm.
You know, you're buying it for say 20 to 30,000. Then you got to put 20 to 30,000 into it. If a person can barely afford to buy that $20 to $30,000 house with government assistance, how are they going to fix it up?
Right.
How are they going to make that habitable?
Mm-hmm.
So I had the opportunity to go with Tom a couple of weeks ago to Washington, D.C.
Mm-hmm.
We had the opportunity to sit down with 4 senators, top aides. We also got to sit down with Maxine Waters, one of her aides, or chief of staff. You know, and sitting with these folks, we got to understand why they have this push. I get it; it makes sense. We want people to have some sort of pride of ownership. There's nothing wrong with that.
Right.
But the problem is you can't solve it with tax dollars.
Right.
I had the opportunity to explain to these folks that there is, in my opinion, billions of dollars being untapped in the form of private investment capital that we could access, that you could have investors come in, buy those $30,000 houses, put the $20,000 into it to fix it up. You now don't just have a $50,000 house, you'll have like a $65,000 house, because now it's saleable on the market as something that's ready to roll. And then you can then screen the tenant to go into it, right? So not only did you now make that home, that one asset, worth more, but now you have put somebody in there that you have screened to be a little bit more of a responsible person with that asset. And you can do it to the neighboring house and the neighboring house and the neighboring house. Now what you've done is you have improved a neighborhood over a short window of time.
Correct.
All with private capital. The problem that we have at that point now is we don't have the ability to carry those notes as an investor. I can't sell that home to the tenant and carry the loan for them, because it's illegal. You get a due on sale clause at that point. The other thing that you're going to run into is if you own the house free and clear, you can only privately finance 5 a year as an individual. So in a way, we have stifled the ability of the private market to be able to help other Americans. Americans are helping Americans, right? And help them to be able to carry these notes on these homes at reasonable rates, and be able to provide them the opportunity to finance these homes. And eventually, once they've proven their ability to make a payment on that and maintain that, then us be able to, me and the finance industry, be able to refinance them into a 30-year fixed loan, whether it be government-backed FHA, VA, or USDA, or even a conventional. They may even have enough equity and they get a conventional loan without mortgage insurance. We have prevented that. Many places, because of that, one of the guys was there from Texas. It said that since the crash and since the action, them putting into place the SAFE Act, that there are parts of Texas that have gone up 100% in value. Now, if they were allowed at that time for these folks to be able to carry those notes, for those tenants who really wanted to have ownership and make a payment and carry, they lost out. Those tenants, those lower income housing folks, lost out 100% growth in their wealth. Now, in the theoretical process of your wealth being tied up in your home, in that world, that is correct. A person who only has the ability to make a payment on a house, saving beyond that's a little bit tough, then all their wealth is tied up in their home. We blocked that group. We blocked it with legislation. So my goal, along with Tom and others who are there, to continue to keep going face to face with those folks who are listening. I got pulled aside by 2 of them. In fact, one of the folks that pulled me aside was Maxine Waters, chief of staff, and said, "Hey, here's my card. We need to talk later." Now, I want to make sure that whatever I tell them when we're talking has a lot more research done, a lot more information available to us. So I'm putting a lot of time into that to ensure that the information I give them is going to be beneficial. It's not just some spitballing that's theoretical.
No, that's really interesting. You even talked about that. So we've even noticed that with lease options here locally, where 3 or 4 years ago were lease options purchase price is $129,900, and now the property is worth, like you said, $150,000. So that would have been, had they purchased and exercised that option, they would have bought at $130,000, and they would have gained $20,000 in equity just in the time they were holding it. So it's kind of an interesting thought there.
Exactly. We could have refinanced that. We could have refinanced that out for them into a 30-year fixed deal right away.
Right. Sure. I mean, both of them are, and these were for the people who needed that time period just to get themselves ready to get the loan, to get to your doorstep, more or less. So that's definitely an interesting situation. A lot of people are doing that here locally with the lease options still, and we've noticed a pullback on that. But tell me about the current interest rate.
On that, just on that note, real quick, one of the goals that I have, is, I'd mentioned how I like, I push myself as kind of like the CFO to their real estate investment business, but also with that, we as a team, I have a team of 15 folks that we will coach those individuals that are going into that lease option and signing that lease and exercising that option well in advance.
Right.
They may have a year or 2 years to clean themselves up. We will walk them through the process.
Yeah.
Do a regular check-in with them. It's necessary that we need to help them to change their mindset. Whatever they were thinking that got them in this mess, they need other thinking to get them out.
Right.
The only way that's going to happen is to have people with an external perspective to see all the potential hazards and be able to coach them through that. So 2 years a year or 2 years down the road, they're successful in the exercise of that option. If we don't take responsibility to help them, and we don't need to help them by giving them money. We need to help them by educating them and teaching them and showing them how whatever they were using as far as their best thinking in the past, how that error got them there. That's I think where we need to spend more of our time and our resources.
No, I think that's excellent. I know a lot of guys who do the lease options who really have no interest in actually, or they would prefer the tenant there to not purchase. So in that case, they're not really out to help the community, but there are a lot of people who do. A lot of people who are trying to help those people, and so I think exactly what you're talking about is huge, and providing that back end service to help them get to the closing table. I think that's huge for sure. Absolutely. So transitioning into interest rates, interest rates have been all over the place. What do we have now? What's the current interest rate?
We're in the mid fives for the 20% down investment property, probably the mid to low fours for your owner occupied stuff. You do. There's many people because of rate. The one thing I'll say, you don't need to be so rate driven. Too often people get very, very rate driven. It's like, well, what if I put 25% down? What if I put 30% down? Because they want that little bit lower rate. So if I'm talking 5.5 for a 20% down loan, but then they can give, say, 5% or 5.125, maybe in 4.99 by putting 25 to 30% down, they're like, all of a sudden they think that's awesome. I'm paying less in interest, but they don't realize they're actually cutting themselves off.
Right.
I really try and spend a lot of extra time on every initial conversation to help that investor who's now entertaining this, that spent their entire life thinking the interest rate's where they've got to shop around for, to help them understand the interest rate really doesn't matter that much when you start considering, as a real estate investor, you own a business. If you put in 20% of the down payment, let's say $100,000 property, you're putting 20% down, that's 20 grand, right? If you're financing 80%, that's 80,000, right? And if you hire the right team, or you merge with the right team, such as the Olson Group, to run your business for you, and they went and sourced. The Olson Group sources a solid property to acquire, to rehab, to manage, to maintain, and that stays rented. Well, if it stays rented, who's paying that 80% loan? Who's paying that $80,000?
The tenant.
The tenant, right? And so if the tenant's paying that $80,000 off over 30 years, that means the tenant is paying in your behalf $2,666.66 per year.
Right.
That is growth. Your $20,000 is now growing by that amount on an average for 30 years. That means it's growing by 13.33% of the original $20,000 every year. That doesn't matter what the interest rate is, because they're paying the interest too. And when the interest goes up, who's paying it?
Right. That's good. Yeah.
Exactly. The tenant's paying that interest too, right? Well, the property owner, which is your landlord, they get to write that interest off as if they paid it.
Yeah.
So when you really get down to it, it's pennies differential, and it really, truly is pennies. I did I have an article on Bigger Pockets that I put out there, and I can send it to you guys. You can post it up on your guys with this particular podcast, so they can read it. An analysis of 1% differential. By the time the taxes were done for this gentleman, it was no longer $49 and some odd cents difference in cash flow. It was actually $3.55 per month. So I'll get that off to you. But interest rates, I know I get going here, but I'm going to share with you a screen.
No, that's all good.
I'm going to share a screen with you. Can you see this?
Not yet.
Okay, let me see. I got to double click stuff. Here we go. Now it looks like it wants to work.
There we go.
Okay, so you can see this chart here. Now this is showing us the mortgage-backed securities chart. This is the trading of the mortgage-backed securities on a daily basis. Every one of these, what they call the Chinese candlestick, or the Japanese candlestick, one of those two. These candlesticks reference one single trading day. You can see in the green one here where it starts and where it ended was at a higher point. And if you see the little wick go up, that means it traded to a higher point and receded down to where it actually stopped the actual candle body itself. And you see the red ones, you can see where the wick is where they traded to its highest point. The other wick is where it traded to its lowest point and actually traded downward from the start of that day. So this actually references the last, looks like the last quarter. If we look at the last several years, I think this will be a 3-year chart here that I'm pulling up. It's going to take a moment for it to load. But if you're looking at these charts, this is a year to date. I'm going to get our maximum chart that covers all the way back to 2014. So you can see all the trading since 2014, what has gone on in the market. So our best rates in the since 2014 was right before the election, which is right here, November 2016. You see where it dropped off. Remember, you recall why it dropped off after the election?
What's that?
Because everybody, there's a massive spike in the stock market after the election. Everybody thought that if you elect Donald Trump, the market's going to crash, right? Everybody's going to sell off the stock. We're going to kill the stocks. Well, what literally happened was the day after, stocks actually sold off in pre-trade by 1,000 points. We gained it all back in the opening of the next day, and it went on a massive run, one of the biggest runs we've ever had. So that's where interest rates get spiked, and they continue to spike. You get over here at the end of 2017, early 2018. That was when quantitative tightening kicked in, right? Quantitative easing was the lowering the rates, the federal fund rate, and investing into the mortgage-backed securities. Quantitative tightening kicked in at the end of 2018. Our interest rates spiked up again. It bottomed out in November of 2018. It's worked its way back to where we are now in the mid-5s for real estate investors. So we're right now in that particular trading field. We're waiting to see. I think investors are waiting to see what's going to end up happening in the stock market. Because the stock market, if it pulls money in, it's usually pulling it from the bond pools. Part of those bond pools in the mortgage-backed securities pool. So as you can see right now, we have had a point where about 5.375% on March 27th was probably where the best rates I've seen so far this year. Actually, in about the last year or so. And we are now doing a lot of those in the mid-5s based upon the current value of the mortgage-backed securities. So depending upon those values grow because people are investing their money there. Now, when people invest their money into those pools, it's mostly, a lot of pension funds put their money there. That means they're expecting a return. So anybody who's borrowing money, it's not the bank money, it's not government money. This is somebody else's pension. In most cases, that pension, they're expecting a rate of return, right? If you invested your money somewhere into a bond, would you not be able to reasonably expect some sort of return?
Sure.
You would think so, right? So these people who put their money up, they're taking on 80% of the risk for your investment, for your investment home. And they're going to accept now for the next 30 years a flat payment based on 5.5%. What is inflation doing to the dollar right now?
Pushing it. It's pushing.
Exactly. It's making it lose value every single year. Yeah, the government's trying to keep it within 2%. It's actually about 5 to 7%. I'm looking at, in fact, I'll just show you an inflation chart on something called shadowstats.com. Did that chart pop up here?
Yep.
Okay, so the red line is the government's inflationary numbers. You look at this blue line, that is the actual inflation numbers if you take into account all the things that they've exited out of the core inflation report, the consumer inflation report. So actual inflation is probably 5 to 7%. So we're seeing this big gap. So what that tells us is if you can lock in a 30-year fixed loan and pay that for the entire 30 years, that dollar is losing that 5 to 7% in value every year. So that means that they're willing to accept less and less every year, but we get to raise rents, right? With inflation right now, annually, it's about 3.6% across the country. But if we can raise our rents 3 to 6%, 3 to plus % every year, you're getting a compounded growth. But we're paying it back with the dollar that's losing value at a compounded rate. The investor gets to keep the spread. who cares what the rate is? Because over the next 2 to 3 years, you're giving them less anyway. A lot of people think, well, I'm paying all this money in interest over the years. No, you're not.
Right.
By year 10 or 12, I actually have the professor of accounting with Kennesaw State University. He and I are working on some curriculum changes together to try and add some things for the students to look this up. But it might be within 10 to 12 years, you're literally paying zero back, but you get to write it off as if you did. If I was on a podcast with another gentleman in Oklahoma, Corey Boatwright night, but he would reference, as I brought this up, he did some quick research while we're on the podcast, and he said that today's, if we were trying to make today's dollar equal what it was in 1930, it'd take over $220 to equal one 1930 dollar.
Wow. Yeah.
So, and that's basically, that was 30 years is 1/3 that time frame, probably a little bit less than that. If that's the case, that means you take $220 and divide that by 3, and I'm not going to do that in my head because my mind does not work as fast as it should. You're talking about $73, right? In 30 years, the dollar you're giving them you'd need 73 of those dollars to equal the dollar of today, or vice versa. Basically, you're cutting it down. That's significant. A dollar is worth 73% less, or 73 times less over 30 years. Why would you even ever want to pay $1 more on your mortgage when somebody else is paying it for you?
Right.
Keep the difference. Keep raising the rents.
Well, I see that that's consistently, in my conversation with investors, that is consistently something that's forgotten. That is the forgotten value add or wealth driver that they forget about. They're very cognizant, focused on that cash flow number when an extra comes in, or a repair, or a maintenance issue, or even a vacancy for that matter. That's a huge deal, but they fail to remember that every month that they're paying down that mortgage, a huge value add wealth driver there. That's just enormous. So definitely an interesting way to look at that for sure. So in my experience, last year, before the interest rates just went down recently, a lot of investors were actually pulling out. They were saying that they missed the boat because of the interest rates. And so you've kind of touched on some of the mindsets and how that should be changed, and how the interest rate should not be as much of a factor as we've made it, especially when you look at the last 30-year snapshot of where the interest rates normally are. What are some other things that investors are missing? So we mentioned interest rates. What else are they missing when it comes to investments, or what are some mistakes you're seeing from other real estate investors?
Well, the main mistake is just what we were just talking about, looking at the one thing the wrong way. I really like to get across to everybody the pro forma is going back to that professor I just referenced. He tells the students the pro forma is Greek for made up, of course, tongue in cheek. I know you guys do the best that you possibly can to give as good a pro forma as you possibly can, as real as possible. But I'm here to tell everybody, please listen to me, that the pro forma is basically used for one thing and one thing only. That's to sort through the properties that you have to offer as to which one you want to take on.
Correct.
And then once you have figured that out, don't sort it between you and some other seller in another state. That's not what it's for. It's not to go and analyze between multiple people, because the numbers you use is vastly different than what somebody else has used.
True.
And the numbers that you use is your analysis for them to decide which of your 10, 12, 14 properties you're offering at that time. And then once they've decided with that pro forma, I'll just be completely blunt and crude here. You take that pro forma that you've decided on that property. Once you've used that tool, you wipe your butt with it and you throw it away, because none of it in there is of any value beyond that point.
Right.
Because everybody, like you said, gets really centered on the cash on cash return model, right? Well, I put this amount of money and I get this amount of money back. They fail to look at, and it's because we have not educated them properly. They fail to look at the amortization of the loan being the biggest contributor to their wealth, period. How many times they have a money market account? They get all excited because the value went up. But did a single dollar go in their pocket? No. They get all excited about this money market. I put in $110,000 and now it's worth $12,000 after 2 years. Look at all this money I'm making. No, you're not, because none of that money's there. It's amazing how they will scream how awesome they're doing, but then when the market drops, where are they at, right? Yeah, they say, well, I never really saw that money anyway. Now they're justifying it in their head that, well, I'll just write it out because it wasn't in my pocket to begin with. But for some reason in the real estate world, they can't use the same math and the same methodology because they've been taught to think otherwise, because there's more money in the real estate in Wall Street for the people on Wall Street, not the people investing in Wall Street. Right. So there's that failure there. The other thing is with the interest rate, they don't realize where the tax benefits come from that.
Right.
When somebody else is paying the note and paying the interest and you get to write it off as if you did, there's huge value in that. And when the interest rates go up, part of the article that I had written is a comparison where I had a client that had won the contract on 2 homes in Memphis, Tennessee. They were both new builds. They're on the same street, same floor plan, same potential rent, same price. The only difference between these 2 properties is one was almost done being built. The second one had yet to break ground. So he closed on the first one, and this gets right to what you were talking about.
Right.
Closed on the first one in December of 2017. Interest rate was 4.75%. So he had a certain amount of cash flow he could count on. Then May happened of 2018. We saw in those charts that the quantitative tightening started to happen at the end of 2017. Interest rates went up 1 full percentage point between December of 2017 to May of 2018. So quantitative tightening kicked in. Because that 1 full percentage point, he saw the numbers, his cash flow dropped by nearly $50 a month.
Right.
He called me and says, Aaron, I think I'm going to cancel the second deal because I'm losing $600 a year. I asked him to explain, where's the $600 coming from? He goes, well, I'm $50 a month difference in cash flow. And there's like 49 and change, $49 and 90 some odd cents. Well, I asked him, do you remember our first conversation? You're the CEO of your real estate investment firm. You need to make the best decisions for your firm. Do you mind if I play CFO again for a minute and give you some things to think about and take your CPA and ask? He goes, sure. So I asked him to go to CPA and ask him what is the difference in taxes that he will pay on property 1 with the higher cash flow, $600 a year, versus property 2 with the lower cash flow. And then what is the tax deduction he will get on property 2 with the higher interest rate versus property 1 with the lower interest rate. Now, he left there with a $600 per month or $600 per year difference in his mind in total revenue. He came back with the realization that with the tax deductions and the tax differences, he was actually only $3.55 per month different. And he got it from a third party, not from me. I just gave him the stuff to go research. He come back and he was happy. He closed and he's gone on to purchase more properties. So that goes to show the value that is there in hidden places that we don't realize that no pro forma ever shows. There's hundreds of percent in return when you factor in the inflation difference and the gap that you get with inflation, paying it back with with lower value dollars. The fact that you get the amortization on the loan, that's 13.33 on a 20% down. It's actually, if you do a 15% down, it's 18.88%. You do 20% down, it's into 10%. So why would you go to 25% down? Why would you put more money down? That's your money. Keep your money. Now, then you get into not only a potential appreciation, right? There's several other things that can kick in here that would be of value. So we need to look at all angles and see where the benefits are instead of just looking at the cash flows. Cash flow is a cherry on top of it. We get into the cash flows, that's even way bigger.
Oh, that's huge. That's such a huge piece. And we try to coach them across the board. We do try to talk about the wealth drivers, but we should preach that, hey, you should get some cash flow too. Sometimes people are.
Well, I'm not going to say, I never say don't get cash flow. I mean, because that's where, if you're not getting cash flow, then don't buy the thing, because why would you go to your pockets to maintain your business? Your business should maintain itself and then eventually maintain you.
That's good. Absolutely. That's the whole, that should be the point. Absolutely. You nailed it. So I really appreciate helping with that question. That's definitely something that is needed and they need to be reminded of it. And it's nice now with the interest rate coming down a little bit from the end of last year. But that's definitely something exciting. So another transition. So we sell, this is the Active Turnkey podcast. We sell the Active Turnkey product. So I'm an investor. I just bought my first Active Turnkey deal. What kind of timetable should I be expecting to refinance? I mean, I'm going to come to you and say, hey, I'm calling you right away. Hey, I just bought this house. What kind of timetable am I looking at? What are the variables that are involved here that I should be paying attention to help get that process going?
Well, it's all a matter of how fast the rehab should be complete, right? So I just tell everybody, listen, before you even do the Active Turnkey process, come to us Let's get your pre-qual done first. Let's get an idea of what you qualify for in the long-term financing world, that good, awesome 30-year fixed stuff.
Mm-hmm.
And then we'll work with you to go out there. Once you find the property, we'll look at what the potential end result value might be.
Mm-hmm.
What is your process for that active turnkey process? So let's say you acquire a property. What would be some numbers? Say 30,000.
Well, typically we would use, let's say $100,000 after repair value. So they would normally, in this typical illustration, say buy for 50 for $100,000 home.
Okay, so $50,000 acquisition price, and what is our rehab cost to be able to get that $100,000 valuation?
We'll say 30.
30. So you're talking $80,000 total in, right?
Correct.
So what I coach them to do, and I remind them, and they need to send me the paperwork before they actually close on everything,
Mm-hmm.
is before you actually sign and put your money at the title company,
Mm-hmm.
I want to see the preliminary settlement statement.
Mm-hmm.
I want to see the $50,000 on line item 1 for the purchase price.
Mm-hmm.
I want to see somewhere in there $30,000 to the contractor
Mm-hmm.
set aside as your rehab costs.
Mm-hmm.
And title can hold those funds and then deploy that upon the completion of construction.
Right.
Now what we have seen that you have deployed $80,000 for this acquisition, correct?
Right.
Per the HUD. Now, since that is deployed at that point, the day after you close, I can start the refinance process on those funds. I start a loan for that. So when the day that the rehab is complete, and I will stress this over and over and over again,
Mm-hmm.
the day the rehab is complete, we will not send it and I will refuse, and I will fight, and I'll kick, and I'll scream, and spit in the phone at them to not send the appraiser out there until the rehab is 100% complete.
Yeah.
I want that place spit polished. I want the lawn mowed. I want it to look like it's ready to roll. I don't want a single nail or a saw or a hammer laying anywhere on that property.
Mm-hmm.
So, because what happens is many people, they want to move it so fast. They say, well, can I just send them the specs and have them go out there while it's in the middle of construction and get me my appraisal so I can close faster?
Mm-hmm.
Well, what ends up happening is we are reliant on the appraiser's imagination.
Yep.
And their imagination sucks.
Yep.
It really does.
They don't.
So
they
what
don't
they do is they go out
imagination.
there and look at this.
They work
not
on,
very well. I do know that.
Yeah.
They work on reality, and the reality is they see a mess, and so they're going to value it as a mess.
Mm-hmm.
And you also don't want to send an appraiser out there after the tenant moves in. Tenants move in hard.
Mm-hmm.
Even the nicest and cleanest people, there's still a lot of stuff stacked around when they're moving in. So we want to be cautious about that. So as soon as I send the appraiser out there, we get an appraisal. And if it comes in 100,000, we have that equity right there, right?
Mm-hmm.
So then we go and do the refinance. I can go up to 75% of the value of that property, that ARV, but I cannot exceed the dollar amount that left your pocket. But let's just say it appraised for 120,000, way above what we anticipated, right? And that's when a person's like, well, I can go to 75%, right? That seems like that'd be a very, very good deal. But the problem with that was that 75% of that 120,000, it exceeds the amount you put out of your pocket. So that's 90,000. Well, that means since you put $80,000 out of your pocket, I can't exceed that. I can get you 100% back of what you put out, but I can't give you cash back for 6 months. Once you've owned that property for 6 months, then I can go up to that 90,000. So that's a point where we're going to have to do a little bit of debate at that point. Decide,
Gotcha.
okay, it took you 3 months to do the rehab, so you got 3 months left. Can you sit on your 80,000 for 3 months, and then I get you an extra $10,000 3 months from now, or do you want your full 80 grand now and deploy it into another property? Well, the question is are you putting yourself behind over time? It may be a great strategy if you're doing 1 or 2 properties.
Right.
So if you're looking to build a small empire and you're locking your money up for 3 months extra at a time, you're actually slowing down your acquisition process. After 4 or 5 properties, you can see that 3 months breaks into well over a year of growth period that you did not take advantage of. So we've got to be cautious how we go about that. We don't want to sacrifice the long game for the small moves.
That's really good. And, there may be some investors who are okay with that. I mean, we've seen 2 different types of investors, guys who they want to be into the deal as little as possible. I mean, to the dollar. Maybe they don't have a lot of money to work with, and so they want to get as much possible, maybe, and get a little greedy. Or like the other one you're saying, where they just want to put their money to work. They don't mind if they're a little bit more into the deal, their own cash after refinance. So that's kind of the identifying what kind of investor you are and what you want to do. Is that accurate?
Yeah, and there's no right or wrong way with that. I mean, the people who want to go in lean, great. You want to go in a little bit more heavy because you have money sitting there. Believe me, it's a hell of a lot better than leaving it into a bank, right? Where inflation is eroding your value. We also know that because of the whole crash situation, a bank has the right. If they're crashing themselves, they can take depositors' money and issue you stock. I don't want their damn stock if they're crashing, right? So taking your money, deploy it someplace else is definitely a good thing. So going light, going heavy, it doesn't matter. But if whatever is your plan, you definitely need to sit down with a team. You need to understand how to execute on that plan, and you need to follow the plan. Too often people start getting online and looking at the wrong places for the wrong things, hoping that they can make their plan, supercharge their plan. It's not always going to work that way. Usually from somebody putting a supercharger on your vehicle to make you go faster, it's going to cost you a lot more and a lot of in maintenance and fuel and all these other things, and potentially just run the damn car into a wall because you don't know how to handle it. It's the same thing. Somebody else is going to benefit, and more or less it's not going to be you when you're thinking of some sort of crazy supercharged plan. Go with what works. And we've been doing this over and over and over again, but let us work a plan with you and work the correct plan based upon what you're capable of, not what you really, really want. We all want a lot of things, but what we want has actually, what people have wanted and what they've pursued sometimes has killed them. We got to be careful with that.
That's a really good point. Something that I try to drive home working with our buyers. I mean, the Active Turnkey or the BRRRR method, anybody can do it. And a lot of people have tried to do it. Of course, our market's fantastic, located here in Northwest Indiana. So anybody can do it. A lot of people try to do it from across the country. The difficulty is making sure that you have all of those parts working correctly. And at that point, if it doesn't work, then you can't really blame anyone but yourself. Whereas if we do it and for some reason something doesn't work, you can blame us. So it's definitely a way to look at that for sure. So good stuff. Absolutely. So now, I bought my first, now I'm a seasoned guy. I've done, I got 10 full loans myself. And, actually maybe my wife, she has 10 herself. So now we've maxed out our Fannie loans. What do? I want to add more properties to my portfolio. I don't want to buy cash. I'd like to still leverage. What do I do next? How do I keep on adding properties to my portfolio?
So I've aligned myself with some folks that have opened up product to be able to help people in those worlds, right? So there's a couple different things that folks are doing. One is they'll continue to buy one at a time, utilizing a firm that I work with quite a bit, where I refer them over. I don't do those kind of loans myself, but I make the introduction, and they'll actually set up for 20% down, 30-year fixed, and it will it's going to be interest rates are about, I'd say 0.5% to 0.75% higher than regular Fannie Freddie stuff. But if you're finding the right property, it's deal specific. You can't just say, well, they suck because it's a higher rate. You got to look at the deal. If you're finding a property that's going to cash flow well enough to be able to do that and turn a similar cash flow to what it would have been for a Fannie Freddie deal, then why would you not get that, right? Because again, you get to write off that interest even though you didn't pay it. And we've proven that even a higher rate doesn't hurt you. It actually can help you sometimes. So look at that. We do have that option available to them, and there's no limit on how many they can get. But it has to be a $75,000 value, right? Excuse me, $75,000 loan size. Let me get that correct. $75,000 loan size is the minimum. So I would tell everybody to be focusing on $100,000 properties. Give yourself a little bit of padding. Focus there, and if you find a deal that works right, let's look at that. I can make that introduction if you're reaching that point. Another thing that folks are doing, and is becoming more prevalent, is what's commonly known as the blanket loan or the portfolio loan. So they take their 20 properties. Husband has 10, wife has 10. You lump them all together into an LLC and then finance them with this portfolio loan that covers all of those with one loan, right? And then you move it over into that. Now, the problem with those portfolio loans, they're typically a shorter term, right? You can get a 30-year fixed in some cases, I've heard, but they're astronomical as far as their rate and everything. And it doesn't actually work out in cash flow for you. But you can get like a 10-year right now. I had a client working on one of those yesterday. His quote is 6.1% to take his entire portfolio of 10 or 12 properties, put them into one loan, and then go back out there for using the conventional loans for his acquisition engine, if you will, and that's his warehouse. At 6.1, it makes sense.
Yeah.
So there is that is out there. I've got a few of those going for clients as we speak. And so I've referred that out to another source where they're working with them. Now, you as the CEO of your business have to make the decision as to whether you and I will work with them. You decide. You're the one. I'll make the intro, but it's not up to me to decide for you. I'll give you as much information as I can as what I've seen other people do and how they've been successful. But you got to take ownership of that. You can't go start blaming somebody else when things don't go right.
Yeah, it is that's where you get into the relationships, and that makes a lot of sense. Especially when you're reaching those types of decisions. That's important stuff. That's good information. Especially after this.
Exactly. We're grown ass people. We need to own up to our own stuff.
Yeah, especially this long. If you've done 20 deals, you've created some relationships at that point. You should be able to transition that over. That's really good. So we've actually talked about Active Turnkey or the Burr method. So we talked about, I bought my first. Now I'm talking about I bought 20 deals and they're all leveraged. What's the power of it? What's the power of Active Turnkey or the Burr method? What are the benefits that you could tell someone who's never done a deal and has heard a lot about it? They've heard us reference it throughout this podcast. What are some of the benefits, the power of it, that you would say to them on the lending perspective?
Well, I've had actually many clients do it, and I've seen people really capitalize to the extent that they were able to use their funds or some private capital to acquire. And then once we were able to go through the refi process, because they analyzed property properly and got something that was worth more than they paid for it. So then we were able to finance that 30-year term loan with very little out of their pocket, or sometimes none at all. I had one client, he did it 5 times. He started with a $75,000 line of credit, bought 5 homes. The first 4, he got every single cent back that he put out from that line of credit and put it back on the line of credit. But by property number 5, he had to leave $12,000 in the deal. Literally secured 5 properties with $12,000 of his funds.
Right.
You can't get more powerful than that. And was he upset about the 12 grand? No, he was grateful. It's like, wow, I left 12 grand in. It would have been awesome if he didn't have to, but $12,000 of his funds. You can't tell me he's not happy, right? Now, is it always going to work that way? No. I've had some people, they made the mistake. The mistake I ran into with the Active Turnkey model is not in the Active Turnkey model. It's in the individual and their mindset towards it. They're of the belief that I'll come in with, I'll do a hard money loan. I'll come in with $5 grand and I'll get my $5 grand back and I'll do it again. And then it came out that when it came to the time to refinance it and the property value was established, they actually had to come in with a couple more $1,000. You would have thought somebody just burnt their house down. They turned inside out, pissed, was yelling at everybody. I was told $5,000. I said, well, you were told by the wrong people. Yeah. You were listening to the wrong folks that are trying to sell you on something. You come in with literally $7,000 on a $100,000 home. Yeah. You should be screaming from the rooftops of how awesome that was, because but first-time home buyers aren't getting that. And you got it as an investment. So it's really the main mistake that I've ever seen is the expectations are wrong.
That's good.
You need to just understand that sometimes you may have to come in with the full 20%. It may end up being the same deal you would have done if you purchased it outright. It doesn't matter. You still have controlling real estate, and when you consider the long game, it's still going to pay you hundreds of % return. Be prepared to have to put in 20%, but be grateful when you don't.
That's a really good point. In fact, I like that, even the 20% concept, even though that the goal is always to be, if you can, hey, why not? We'd love to have you out of pocket nothing, right? $0. But the expectation, and I think sometimes in my seat, because I sell the Active Turnkey product, I try very hard to share the risks, the front and back end risk, the extras. You're into it more than you originally thought you would be. But it's difficult for them to hear it sometimes, because it is a good product and they see the numbers and they see the potential, and turns in from potential to expectation. So I think that's a really good way to put it. If you can, like, again, if I'm that guy and I'm an average of $3 grand, a deal, or $2.5 grand a deal, whatever that would be, out of pocket for 5 houses, I'd be a pretty happy guy. I'd be a happy camper for sure.
Yeah, exactly. Oh, he was ecstatic.
Yeah, I'd hope so. So last thing. So we talked about a bunch of different things, and obviously as a lender who works just specifically with real estate investors, why rentals? Why should I pull my money out of the stock market? I've heard of the risk, I know, but why? Explain it to me. Why should I do that? Why should I do that over lending or any these other options? Explain to me why I should go into real estate.
Well, it takes me back to a really, really early time in my career. It was about 1999. And I went to a guy's house. I'm in Arizona. That's where that's where my licenses are. That's my home. I only get to come here once a month, right? But when I was there, I went to his home to work on a refinance of his primary residence. And as I was doing his application, I found that 100% of his income was coming from rentals. He owned 10 rental homes, free and clear, that he'd paid off over his lifetime. Then he retired when they're all free and clear. And his whole job was to just collect his rents. I stayed in contact with that guy for a while because he kept telling me, this is what you need to do. You want to retire? This is what you do. You own rentals, right? I couldn't wrap my head around it real well because I was very young. I was renting at the time, right? Well, I noticed, and what really hit me hard was during the crash of 2001, I think it was, with the dot-coms. When the dot-com bubble hit, he was still retired. But many of my clients who were retired had to go back to work. And because they were tied in the market, they had a lot of money tied up in the stock market, and they lost their revenue. Their money that they had that was in there, that was paying them the monthly interest and those dividends that they were hoping to get to live off of, was vaporized. This guy didn't have to do that because he had all his money tied up in his rentals. And as he saved up enough, he'd buy another one. And so that taught me right then that when the market moves like that, you're tied to something like that. It's much like it's a commodity. It's real estate. It's so many different things all wrapped up in one that I learned firsthand that's where to go. So then I started actually investing in real estate myself. But I started investing right around 2000. I think it was right around 2003. I started pouring money after money after money. And every time I got an extra dollar, I'd sell properties because properties were spiking in value. Now if I didn't make $50,000 in a week, I didn't walk across the street. Right. And that's kind of what I was thinking back then, because you're making so stupid amounts of money. But I was pouring into other properties and other properties and other properties. And I got really, really cocky. And then 2008 happened. I got in a crash in a motorcycle accident in 2008 that put me in a wheelchair. In fact, I woke up in a hospital bed. And did not know where I was at. And at that time, I couldn't grow a beard before that. Everybody asked me about the beard. I had a spot right here that wouldn't fill in. But I took an 80 plus mile an hour header off of a Harley and tore that side of my face up. I woke up in the hospital with a beard. It was the awesomest things in the world. I was like, now I have a beard. So I decided I'm not going to trim it till I learn how to walk again. And I was trimming it until I ran into Ron Phillips at an event, and he had just trimmed his beard. I just trimmed mine. He's like, hey, yours is longer than mine is. And I said, well, I just trimmed, but next I won't trim until I see you again. As you can see, I've not seen Ron Phillips yet. And I'm not going to trim it now. Heck with it. I'm not going to trim it. But ultimately, when I came out of that, and I know I'm digressing rather heavily here, but when I came out of that, I had lost all of it. I had $2.1 million in real estate at that time. It was all gone. I had to wheel up to title companies in my wheelchair and sign off on those short sales. And ultimately, because when the creditors were calling and they're trying to chase me down, and they finally got me on the phone after several weeks, because I was not allowed to have a phone for some time. I was able to explain to them. They were like, well, why isn't you paying your bills? I was able to send them a $1.7 million medical bill for the first week in the hospital. They back off pretty quick when they see that, right? And by the grace of God was I able to keep my home and my vehicles, but everything else was vaporized. I lost it all. And so I get to start over. And the reason I lost it all is because of my approach to real estate. I was looking for appreciation. I was not in the cash flow market at all. In fact, I was having to pull from my credit line to cover the cash flow net differential. I was in the hole every month because it was an $18,000 a month net to crack, right? But the amount of revenue coming in was not that. I was having to bridge that revenue with my personal revenue. And my personal revenue was not matching up with what my total expense was. I was still short by a couple grand. So I was having to supplement that with a credit line, a $200,000 credit line.
Wow.
So when you start considering where I was at, I put myself in a very, 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 very bad spot.
Oh yeah.
And I'm still paying back that $200,000 credit line because they locked in that credit line for 30 years at 4%. Why would I pay it back, right? I'm going to ride that sucker out till death. I'm actually now paying it back with I'm going with an agreed upon value of that dollar back in, what was that, $2010. Well, what's the dollar worth now compared to 2010, right? So I'm paying it back with pennies in comparison. So I have personal experience. I've got scars. I mean, I can strip down and show all kinds of scars that I have gotten from the market as a result of that crash, my own personal crash. So everything that I offer to a person comes from the experience I got from working with investors and the beatings that I have taken. And I've taken plenty of them.
I think it's vivid. So I think it's always important, even for me, selling turnkey rentals for several years until I bought my first one. But being an investor myself now, I have 4 properties and starting to build up my own portfolio, being able to understand not just, hey, what the numbers are, but to be able to say, hey, this is what I'm doing, or this is what happened to me. So to be able to not only visualize that with your clients, and because you've done hundreds and thousands of deals, but because you kind of went through it yourself, it's a pretty powerful example. So Aaron, I appreciate you coming on. It's been a pleasure, and we definitely will have to do this again and have you back on the podcast. And so definitely Aaron is a lender we recommend. If you have any questions or want to hook up, we can definitely help you with that and get you connected. Aaron does a lot of our lending with some other key lenders we work with. And so if you're interested in any properties and would like to look into some of the deals that we are selling and then even send to Aaron, you can reach out to me, Jarrod, at buyolsongroup.com. And again, it's what we do. We build rental portfolios for investors. So Aaron, thanks for having us on, man. Thanks for joining us.
Thanks, Jarrod.
All right, buddy.
Appreciate you, brother.
Okay. Olson Group Network makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Unless specifically stated otherwise, Olson Group Network does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. Any third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of Olson Group Network. Olson Group Network assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials or on third-party sites referenced in this podcast or the compliance with the applicable laws of such materials and/or links referenced herein.